customizable dashboard that is free for users. Follow them at PyQSuite on X. Here's the question keeping Wall Street up at night. Can stocks keep rallying if AI wipes out millions of jobs? The answer might surprise you. Write this down. Here's the bottom line this Tuesday morning. AI paradox. Stocks can rally even as AI kills jobs. Wealth consolidation is not bearish for equities. Position for the bubble. NVIDIA. Earnings tomorrow. The AI tell. Both models are bullish equities. Regime is risk on. Signals. 8 of 11 sectors bullish max value over growth. International broadly bullish. Gold max, dollar short max risk. Crowded positioning means high medium-term crash risk. But short-term correction risk is low. Ride the grind, size for chop. Now let me show you what the data is telling us. Starting with overnight developments. Big story from last night. President Trump delivered his State of the Union address. Despite the Supreme Court ruling against IEPA tariffs, he's pivoting to Section 122. The tariffs stay. Markets had to digest that overnight. Japan's Nikkei hit a fresh record high. AI panic is fading, yen is weakening, and Goldman is calling for more upside. Former BOJ chief Kuroda, the architect of Abenomics, is now calling for 1.5 to 1.75% rates. That's a massive shift from the man who gave us negative rates. Germany GDP came in flat. Zero growth quarter over quarter. Europe continues to limp along. Gold pulled back overnight, retesting the 5,100 level. Momentum fading. And oil is holding near 7-month highs ahead of U.S.-Iran talks in Geneva. Today's lesson. Can the stock market perform well if AI permanently impairs the labor market? Short answer, yes. And here's why that matters for your positioning. The macro strategist framed it perfectly. AI is simply another tool engineered to consolidate wealth and power. Just like globalization. Just like the tax code that favors capital over labor. In isolation, wealth consolidation is not bearish for stocks. New research from Harvard, Penn, and DePaul found AI can predict 71% of active mutual fund trading decisions. The algorithm internalized the industry's standard operating framework. But here's the key insight. The 29% of trades AI couldn't predict were more tightly linked to excess returns. Alpha lives in the unsystematic decisions that deviate from the template. Fed Governor Lisa Cook warned their toolkit may not be enough to offset AI-induced job losses. Equity impact. Bullish for stocks in the medium term. The profitability tailwinds from productivity growth are incredible, but it creates a K-shaped society that eventually becomes unstable. Position for the bubble, but know it ends badly. Now let's check the health of this market with 5 key internals. VIX at 19.49. Sub 20. The fear gauge is in the calm zone. Range bound between 18 and 22 for weeks. Equity impact. Bullish. Sub 20 VIX historically supports grind higher price action. VIX term structure in contango. Spot at 19.49. 3-month at 21.34. Normal structure. No panic hedging. The risk on regime is intact. Equity impact. Bullish. Contango confirms an orderly market. DXY at 97.79. Down fractionally. Continuing a multi-month slide from the 108 highs. Capital rotating out of U.S. assets. Fed on hold. Rate advantage fading. Equity impact. Bullish for U.S. equities, gold, emerging markets, and commodities broadly. Breadth. RSP up 0.8% versus SPY up 0.73% yesterday. Equal weight outperformed cap weight. Broad participation. The troops are marching with the generals. Equity impact. Bullish. Broad rallies have more staying power. Sentiment. Retail is underweight stocks. Professionals overweight. Systematic funds overweight. Historic crowded positioning among institutions creates fragility. Short-term correction risk is low, but medium to long-term crash risk is high. Size for the possibility of violent drawdowns. Let's go through the quant model. This is the systematic, rules-based system. Current regime, risk on. The model says lean into risk assets. Growth index at 10.04, neutral. Growth is stable, but not surging. Economy in cruise control. Inflation index at 10.09, bullish. Inflation is behaving in a way that favors risk assets, not forcing the Fed's hand. The quant model is positioned in leveraged NASDAQ and cash. That's it. Nothing else. No bonds, no gold, no healthcare, no utilities, no Bitcoin. This is a pure tech momentum play. A concentrated bet that the AI trade keeps working. Performance, down 6.1% on the year. Still positive over 12 months at plus 4.6%, but lagging the S&P. Drawdown at negative 18.6%. That's the pain of leverage in choppy markets. But the model hasn't changed positioning. The systematic rules still say risk on. Economic surprises. US at plus 29, data surprising to the upside. Japan plus 19.9. Canada plus 44.8, significantly beating expectations. Emerging markets at negative 14.3, disappointing. Fed monitor, minus 0.20 cuts priced. The Fed is on hold. Don't expect help. Liquidity, US and Eurozone both supportive. No funding stress. The music keeps playing. Now the economic data. Inflation. CPI at 2.39%, trending down, but stuck above 2. Core CPI at 2.51%, sticky. Core services at 1.79%, that's the problem. Core goods at 0.22%, basically dead. Inflation swaps anchored near 2.3% across all tenors. No inflation panic. Equity impact, modestly bullish. Fed on hold supports valuations. Labor. Initial claims at 206,000, stable. Unemployment at 4.3%, cooled from 3.4% lows, but not cracking. The AI angle. Rising unemployment with strong GDP is bullish for profits, but creates social instability. Watch this one. Growth. Real GDP at 3.53%, well above trend and consensus. Real final sales at 2.6%, private demand healthy. Productivity contributing 1.94% to output growth. That's the AI thesis in the data. More output with fewer labor inputs. Rates. 2-year at 3.46%. 10-year at 4.03%. 30-year at 4.68%. Curve positive at plus 57 basis points and steepening. Recession signal is off. That's bullish for cyclicals and small caps. Overnight funding market stable. No stress. Now let's talk through every sector signal. 8 sectors are bullish max position. Materials, cyclical demand strong. Communication services, mega cap tech adjacent, AI beneficiaries. Energy, oil near 7-month highs, geopolitical premium. Industrials, fiscal spending tailwinds, reshoring. Consumer staples, defensive yield working. Real estate, surprise leader as rate fears fade. Utilities, both defense and AI-powered demand defense. Healthcare, steady and underowned, defensive with growth. 3 sectors are neutral, half position. This is your warning flag. Technology, XLK neutral, even though QQQ is bullish. The signal is telling you megacap tech is extended. Half position. Financials, caught between steepening curve positives and credit concerns. Half position. Consumer discretionary, bifurcated consumer. High-end fine, low-end struggling. Half position. Bottom line, broadly bullish with pockets of caution in growth-sensitive names. Factor signals. 9 of 10 factors are bullish max value over growth. That's the key rotation. IWD value is max. IWF growth is only half position. Small caps and mid caps are bullish max. The steepening curve helps. Goldilocks regime favors small over large. Momentum, quality, high beta, high dividend, low volatility. All bullish max. Both offense and defense working. This is a barbell environment. QQQ Nasdaq 100 is still bullish max, but remember XLK tech sector is neutral. The difference is concentration. The biggest names are carrying the index. Global equities. 9 of 11 countries and regions are bullish max. All world ex-US, bullish. The AI productivity convergence thesis favors international. Japan, record highs, bullish max Europe. Despite flat German GDP, equities are working. Valuation discount closing. Canada, significantly beating expectations. Brazil and Australia, commodity exposure. UK, undervalued. Emerging markets broadly, bullish despite negative surprise index. 2 are neutral half position. China, structural concerns keep it neutral. India, valuation stretched, momentum cooled. The signal is clear, international rotation is real. Fixed income signals. Short to intermediate duration and credit are favored. Aggregate bonds, investment grade, high yield, emerging market debt, convertibles, mortgage-backed, and preferreds, all bullish max. Avoid long duration. TLT has momentum, but fundamentals say no position. Avoid international bonds. BNDX is bearish. Macro exposures. Gold is bullish max, gold miners bullish max, silver bullish max, silver miners bullish max, base metals bullish max, uranium bullish max. The precious and industrial metals complex is firing on all cylinders. Dollar is bearish, short max position. This is high conviction. Dollar going lower supports everything: gold, emerging markets, international equities, commodities. Bitcoin is bearish, no position. Ethereum bearish, no position. The crypto momentum has turned negative. Both models at zero. Oil is neutral, half position. Elevated, but momentum is mixed. Don't chase. Agriculture bearish, no position. Now let's bring it all together by comparing how the two models are positioned. The quant model is positioned in leveraged Nasdaq and cash. That's it. Nothing else. This is a concentrated, high-conviction bet that the AI trade and tech leadership continue. Pure momentum. The macro strategist is positioned in global stocks, gold, and short dollar. This is a diversified bullish stance. Stocks for growth, gold for insurance, dollar weakness as a core theme. Where they agree, both are bullish stocks. Both avoid crypto. Both avoid long-duration bonds. Both use cash as a buffer, not a hiding place. Where they differ, gold. The quant ignores it, the strategist overweights it. International. The quant is US only, the strategist favors global. Concentration. The quant is all in on one bet, the strategist is diversified. Dollar. The quant has no view, the strategist is actively short. The takeaway. Both say be long stocks. The quant tells you momentum favors risk on. The strategist tells you how to position for the inevitable chop. Use both signals. Here's your cheat sheet. Rule 1. Position for the bubble, but know it ends badly. AI is bullish profits, bearish labor. Rule 2. Contango equals complacency. Backwardation equals panic. We're in contango. Rule 3. Steepening curve equals recession signal off. Bullish cyclicals and small caps. Rule 4. Value over growth. Small over large. Momentum and quality working. Rule 5. 8 of 11 sectors bullish max tech, financials, consumer disc at half. That's your flag. Rule 6. International broadly bullish. Dollar bearish. Gold max crypto, no position. Rule 7. Crowded positioning equals high medium-term crash risk. Size accordingly. Rule 8. Nvidia tomorrow. The AI tell. Watch it. Screenshot this. That's your Tuesday morning setup. Futures green. Regime risk on. Internals healthy. Breadth participating. But you're only seeing the surface. In the boot camp, we layer the session over.
Hi, good morning, good morning, good morning. So now what we are going to do is we're going to look and start doing our top-down analysis for the day. Right, so when we did our reengineering session at 1500 yesterday, we knew that previous day, wherever it lied, had a 71% probability of being taken out, right? And that the 30th percentile reversal zone was right here at the bottom of the green box. We reached up and touched it overnight. The 50% reversal box is between where green and red meets, and that the red is up here. Now, in the RTH, before NVIDIA earnings, we expect that we will come up and make the high inside of this green box at some point. We know that we are inside of NFP Friday and will blow previous month 50%. So we expect 50% green days, 50% red days. That's what it is, right? We are anticipating, as long as we are, well, we can't get below the NFP Friday box, but the moment we do, we anticipate quarterly lows, right? And if we start closing above this NFP Friday box, next level is previous month 50. Once we get above that, we expect 70% green days, 30% red days, and anticipate higher prices at the end of the month. All right, so moving on to our weekly forecast, right? Currently, we are above Tuesday and Sunday, so we're locking in this Monday 12 o'clock low of the week. It's the low of the week. We know that we have targets up here from a weekly standpoint. That is at 25,333 and at 25,445. So now let's do a comparative analysis. We can see that this higher target, which has an 82% probability of hit, right, like is right above our red 70% intraday reversal box. So we might not expect that to get hit. Probably after the video comes out, it will get hit. So that's what we're looking at. All right. So now, right, we are going to go and check out the weekly. So we are locking this in because live price is saying we're above Sunday, we're above Tuesday. We know Wednesdays have a high probability of retracing Sunday's range. However, we have probabilities to the upside, so we are just going to weigh heavier on our intraday analysis, right? Before we go into our intraday analysis, all right, we want to look at, from a statistical standpoint, using every week of the year, like, did we do normal price behavior at normal times, right? So we can see that there's a 51% probability that the low or the high of the week is in at this point. We know we have the median to the left, and we also have the mode to the left. So majority of the time over the last 56 weeks, by this point, the low of the week would have been put in, right? We know that we came down to the price levels, the median MAE, and so now we're expecting these probabilities to the upside to play towards the MFE, the distribution of the week. So we know right here, this is 100% probability of getting a hit. This is 50% probability of getting a hit, or 80%, 90% probability of getting a hit. This is 80, this is 60, and this is 50. So these targets to the upside still are very, very relevant and backed by data. All right, so with that being said, all right, coming over to our intraday, all right, we see that, let me pull over daily profiler, right? So we see that they bought Asia and Tokyo markets up, they bought London and Frankfurt markets up, and we haven't broken out to the upside. So let's reset our data, start with 4,584 days. We know that Asia was long, true, broken, and we know that London is long, true. We know that now we are down to 286 days that this has happened. All right, so now, right, we're waiting for the breakout. Well, we can see when we come over to Wargaming, right, we can see that a long true would have happened 8.74% of the time. And so that means out of the last 20 years, a long true has only happened 25 days. 25 days, right? We can see a long false has happened 34% of the time based off of what Asia and London did, and that has come in at 98 days. We can see a short true has happened 18% of the time, and that's happened 52 days. And we can see that a short false has happened 38% of the time, and that's happened 111 days. So currently looking at our low of the day, which is currently at 1805 at 0.10%. Now we're going to line up all four possible scenarios with the low of the day. So we can see right out the gate that that long true supports the low of the day from a time and price standpoint. We can see a long false definitely supports that long true, right? From a time and price standpoint, right? We can see that a short true is the only one that does not support that low of the day. And we can see that a short false supports that low of the day. So the one angle that we have right now is, number one, all right, we have weekly and daily probabilities to the upside. And number two, that this low of the day is supported out of the three of the four possible scenarios that we can do around the 730 to 830 box. All right, so now let's go look at this midnight, this London, and this P12 mid. This is going to be a sensitive zone for us, right? Right, because now we're going to actually be able to stack probabilities, right? So, and they're stacked on top of each other. Other zone of interest is going to be right here where it's Globex open and settlement open. So now we're going to go check out these probabilities as they sit right here, right now, right? So we're going to come over to our levels. And the first level that we want to look at is this P12 mid. We know under all four possibilities, this P12 mid has a higher probability of getting hit, right? A 94 to be exact, right? And the time that we hit is between 9:30 and 9:45, right? So this probability alone is a reason not to start buying right here, right now, because there's high probability that we come down and touch this P12 mid and then bounce. All right, now let's go look at midnight open. Right, we can see midnight open has an 83% probability with the mode being at 9:30 to 9:45, which is stacked on that P12 mid. So that's another reason why we shouldn't just buy up here in like where we currently are, that we should wait for a pullback. Right, and then the last one is settlement. Right, on a Wednesday at settlement, we have a 72% probability of gap fill. Let me back up. And then the other level that is stacked on P12 mid and midnight is London OU. We can see London OU has an 88% probability with the mode being 9:30 to 10:30. So that is another reason why we should not just sell willy-nilly, right? I mean, start buying willy-nilly up here at these prices, but we should be a little bit more patient and wait for it to pull back, right? We know that there are higher prices to come, but right now, right, we know that there are probabilities that are high below us, right? Let me do one thing real quick. All right. So now that we know that, now we can check out, now that we know that this is the highest probable retracement area that we can come back to, right? The only thing that stops it from coming to this retracement is if we get a long true. Well, if we get a long true, we're doing something that we've done 2% of the last 20 years, right? So that's not like what we want to bet on. We don't want to bet on 2% of the time we've done this, right? We want to bet on the times that are higher probability. And 3 of the 4 scenarios around the 730 to 830 box says expected retracement here. And then, yes, we can go higher if we need to, right? Now we're going to go look at settlement and Globex Open and see what their probabilities are. Give me 1 second. All right, so now we're going to see that settlement has a 65% probability, and on a Wednesday, right, it's a 72% probability of gap fill. That is another strong anchor that we are going to go down before we go up, right? We can still go up because remember, a long false means that we come and we put the high of the day in. We come and put the high of the day in around 9:30 to 10:30, and then we start heading down, and then we chop inside of this range, right? So now it looks like we might be able to break out of our 730 to 830 range. So we are going to be aware of that. And at this point, right, we know that these 2 levels right here are going to put where we retrace to into context. The 4 possible scenarios, now there's only 2, right? Because we just went long. So we can go up and stay above this low right here until 11:30, and there we go. Or we can go up and then down. So now we know that there's only 2 possible scenarios to expect, and it's this right here to happen between now and 8:30. All right, so now we are going to go and put our high day data on, right, for a long false. Now that we've got the 4 possible scenarios down to 2, right, we can say long. Well, we can see that there's a 78% probability that we go false and then 21 that we go true, right? So we're going to put false in here, right? And we can see that there's a high likelihood that we make the high of the day at 9:30 to 10:15 between 0.7 and we can say 1%. So let's put that in here. 0.7 and 1%. And the highest likely time that we do that is between 9:30 and 10:30. All right, so that's going to come in. And we know that that is inside of this red box right here. All right, this red box right here supports the idea that we come up to come back down, just like this, right? And then we retrace these zones. All right, so real quick, I want to put my reversal zone here in here. And see how that matches up with the high of the day. So that doesn't necessarily match up with the high of the day. We can see that the 30th percent reversal zone to the 50th is in the upper part of that high of the day zone. And that the 50th to the 70th is above the high of the day zone, which would support, so the green zone would represent the long false, and the red zone, if we get in there, represents that we're going to go long true between now and 11:30. All right. All right, so we know that right here, right now, that this is the highest probable movement to have, right? So now let's go check out between now and 11:30. So now let's go check out some other things about this. So we can see that this 1800, let's zoom in on this. This 1800 low of the day is supported but then there's multiple other occasions where the 1800 is not the low of the day. So with this, we will have to play it by a price standpoint, right? So we do it like this, right? First target will be P12 mid, midnight open, London OU, because they're all above 80% probability. Second target, we lose that and we just don't bounce off of that. Then we expect settlement in Globex. And then if we're below that, we expect a new low a day, right? So that's telling us a key story right here, right now. All right. All right. So we know that we can expect the low of the day between 930 and 1600, right? And it's between 0.2 and 0.3. So literally, the low of the day can't be properly defined other than the fact that it's between 0.2 and 0.3 in this scenario, right? So that's why the live price, as we get to those high probability retracement levels, we have to be very, very aware of where they're at and what they're doing. All right. So we know that the highest probable structure to see between 930 and 1030 is to make a new high and then reverse and start heading down into a trend low until 1130, meaning that we can respect our quarter. We can expect quarters to be respected. We can expect a 3-hour line downwards, et cetera, et cetera. So how I'm going to play this today, right, is I know I have to solve for long false versus long true, right? If we blow right through this high of the day zone, then I'm expecting a long true. If we cannot do the 4-step reversal going down, right? So this represents the 9 o'clock box. This represents the 9:30 1-minute candle, right? Step 1, if we can't get below 9:30, then step 2, can we get below 9 o'clock's 50%? Step 3, can 10 o'clock take out the 9 o'clock low and put an instant high in? Those would be the 4 steps that I look for. I will start positioning sizing around the 9:30 first sells, and then I'll add to the position size based off of live price, but mostly it's going to be around the 50% of the 9 o'clock, and then add into winning positions around the 10 o'clock. All right, so to target at least very minimum P12 mid, midnight open, and London OU. I'm definitely aware that today will more likely be a range 1 scenario, even though, and that's only under the context that NVIDIA earnings are this afternoon. However, live price is not telling you to expect a range 1 whatsoever. Statistics are not telling us that. So, but if we start getting a complex 930, if we start swiping it, then that will be my leading indicator of a range 1. The only reason I say a range 1 is we got plenty of distro to continue and make this thing a long true is because NVIDIA earnings is this afternoon, right? So now let's put our distros on the table. We know over the last quarter, from 7:30 to 8:30, the median that we typically put in is 1.10, right? So we can either turn long false by the 50% of our reversal zone, and then we anticipate a new low of the day. Or we can dig deeper into it like this, and then settlement in Globex, or midnight, and et cetera, right? So that's my war game. I will be very, very paying attention to, a retracement. But if live price can't give me the 4-step reversal, I'll have to buy for cash flow targets to the upside. And that's how we'll play today. If I start getting the 4-step reversal, I won't be slamming it heavy with shorts because we're in a freaking good uptrending day. But I will take it to this midnight and P12 mid area. And then from here, based off of the response and what time it is, I'll try to look for longs to make a new high day to dig us deeper into this high of the day zone. So that's my war game analysis for today, right? Definitely expecting something like this, right? But yeah, that's what I'm expecting. So hopefully this helped, and I hope you guys have a great trading day. Later.